Hello, greetings, and welcome to Dividend Blasters. This is our 60th video. Our topic today, more strategic dividend investing. We are at a precipice. This is a once in a generation buying opportunity in the consumer staples sector. I believe it is. This sector is getting beaten up. Year to date, they are down almost 11% at the aggregate level. Some are down way more price wise. Some are down less. Some are up. Okay. But a lot of them are down. So, what I'm going to do is I'm going to go through and I'm going to share with you why I believe there are great buying opportunities here in the consumer staples sector and what they are and why they're great opportunities. Let's jump right in. Before we do, a quick disclaimer: I'm not your financial advisor. So, what I say should not be taken as financial advice. Purpose of this video is for financial information and education. It reflects my own personal opinions, my research, and my experience as an investor for more than 30 years. So please do your own research, consult a financial advisor prior to making any financial decisions. So how did I do this? Basically, I read a lot, periodicals. I talk to a lot of people. I leverage a lot of analytical tools that are available online. And one of them is the Spider Sector by State Street Bank and Trust Company. I think that this is a wonderful tool. State Street Bank manages several ETFs. They're one of the largest ETF administrators like BlackRock and Vanguard and Fidelity. Um, they're one of the big ones, okay? But what they do is they have an ETF that mirrors each of the 11 sectors in the economy. So, as you know, we have 11 market sectors, and they have one that uh, basically maps to each one of them. They have holdings in each ETF that mirrors the stocks that are in each of those holdings, and they all add up ultimately to the S&P 500. Um, and I find this to be a great resource. And so what I do is I check to see what the performance is by each of the sectors. And if I see that something is down a little bit, I do a little deeper dive. I want to know which one of those index holdings are down, why they're down. Uh, I'll determine if I think it's a good value. And if it is, it's potentially a buying opportunity. I'm going to jump. So as you can see on the left panel, go down three of the funds, and you'll see Consumer Staples, which is the XLP fund. It is down 10.57%. And I do love this sector because a lot of these brands, they're everywhere. They're in your home. They're on the road. They're everywhere. We buy these things every day. We really can't live with a lot without these brands in our lives. We've become so accustomed to them. So, anyway, I'm going to talk a little bit about consumer staples. So let's jump in and a little bit more context. So, of State Street Bank's 11 ETFs that make up the S&P 500, their consumer staples ETF approximates around 6.33%. So I think that that's fascinating because it gives you some context of where all these things lie. If you were to look at maybe at the technology sector, you'd see that that's much bigger. Industrial's probably much bigger, but this is a very important sector. Um, and let me just say as an aside, without going too deep into this, if you wanted to buy this ETF, you can buy it. Go to State Street Bank and you can buy XLP. The expense ratio is only 0.1%. And as I said, there's 38 holdings in this ETF. And we're going to jump in and I'm going to share with you what those holdings are. And I think for great context purposes, you will see how they weight these. Basically, of the 38, Procter and Gamble is the heaviest weighted holding, a little under 15%. Then it's Costco, then Walmart, PepsiCo, Philip Morris, Coca-Cola, Mondelez International, Altria Group, okay, the tobacco company, Colgate Palmolive, Target, the big box store, Kimberly Clark, Archer Daniels, Midland, the agribusiness Company, Constellation Brands, Monster Beverage, General Mills, Kenvue, Estee Lauder, the cosmetics company, Cisco, Keurig Dr. Pepper, and the chocolate company, Hershey Foods. It's the left panel. Let's go to the right panel. We're going in order from highest to lowest. Then next is Kroger, the grocery chain. Then the food company, Kraft Heinz. We're all familiar with the ketchup and other condiments. Dollar General, then Dollar Tree, Church and Dwight, McCormick and Company, Walgreens Boots Alliance, the drugstore chain, Bungie Limited, Clorox and Company, okay, the cleaner, Lamb Weston Holdings, Tyson Foods, Kellanova, Conagra Brands, J.M. Smucker, oh, the Jam and Jelly Company, Molson Coors Beverage, the beer company, Hormel Foods, Brown and Foreman Company, and last but not least, Campbell Soups. So those are the 38 holdings by weight. Now, what I'm going to do is next slide, I'm going to go right to it. I'm going to tell you the stocks that I believe are the very best buying opportunities right now at this time. I'm going to just list them. And then I'm going to show you my monster chart and show you what I did and how I got there. All right, but before I do that, I'm going to show you which ones have gone down in price. So, what I've done is I have sorted them from biggest decrease to lowest decrease, and then ultimately to those that have increased. The one that has decreased the most since January 1st is Dollar General, down almost 58%. Then Walgreens Boots Alliance, 41%. Estee Lauder, 36.6. Conagra Brands, 32. Target, 31. Campbell Soups, 30. Kellanova, 29. Smucker, 30. I'm sorry, 28. Tyson Foods, 25. Kenvue, I'm rounding up if you noticed. Kenvue, 25, and that's the new spinoff from Johnson & Johnson. General Mills, 25. Dollar Tree, 25. McCormick, 23. Kraft Heinz, 21. Hormel Foods, 19. Archer Daniels Midland, 19. Cisco, 17. Coca-Cola, 16. Keurig Dr. Pepper, 15. Hershey Foods, 14. Next panel, Kimberly-Clark, 13. Brown Foreman, 12 and a half. Colgate-Palmolive, 12. Clorox, 12. Philip Morris International, 9. Altria, 7 and a half. Procter & Gamble, 5. Mondelez International, 4. Kroger, 2. Pepsi, 1 and a half. Monster Beverage, 1. And then, and those are the end of the ones that have gone down. Now they start to go up. Constellation Brands, up almost 4%. Church and Dwight, 5% up. Lamb Weston, 7% up. Bungie, up 8%. Walmart's up 19%. Molson Coors, up 20%. And our favorite super box store, Costco, 23%. So why am I telling you this? Because was the beginning of my analysis. What I did was I looked at really just the ones that have gone down. I'm looking for buying opportunities. So I'm not looking for ones that have appreciated in price. Even though I do buy when they go up, I'm talking here about just the ones that have gone down. And just because something has gone down doesn't mean it's a good buy. That's really just the beginning here. I am going to show you which are the best buys based on price, but also based on dividend yield, dividend growth rate, uh, the streak of a growing dividend. That's what I'm looking for. Also, the payout ratio, is the dividend safe? Uh, I'm going to be looking at profitability. Okay. I'm specifically very interested in levered free cash flow margin. Okay. How do these companies compare to their peers and competitors in this market sector? Are they generating more profit, more levered free cash flow than their peers and competitors, or not? That's very important. And then finally, I'm going to be looking at valuation. How is their price relative to their earnings? Is this a relatively good buy or not? So I'm going to go through all that, but first and foremost, I'm going to tell you which of the handful of stocks I've selected. And they are, and I've selected only three. I took a lot of time going through all 38 of these. And here are the three. Altria Group, ticker symbol MO, the tobacco company. It's also a dividend king. Archer Daniels Midland Company, ticker symbol ADM. And JM Smucker Company, ticker symbol SJM. Okay. I only selected three. I'm sure there are others where people are saying, well, why didn't you select Coca-Cola and Pepsi? Those prices are down. And those are great companies. And there's others. There's a lot of others. But I got to tell you, I have limited scarce dollars. And I am going to choose the very best buying opportunities, in my judgment, at this time. How did I do this? Okay, here's my chart. So, what you see here, uh, everything that is highlighted in green through index holdings and price shows holdings that have gone down since January 1. So, that's the starting point. Okay, so the ones that are not shaded, I did not look at seriously, even though I will buy them if I think I really like Costco. I do buy regularly, and it's up because I think it's a great company. Purpose of this video is buying opportunities in the dip. That's where we are. So, um, after looking at price, I'm looking at dividend metrics. I'm looking at profitability, specifically around cash flow or levered free cash flow margin. And then I'm looking at valuation or the PE ratio. And you know how I arrive at these three choices? I want to see all green across the row. So, for instance, you would actually disregard the color for the sector median metrics. Okay. Those are basically all the same. So, for instance, the sector median levered free cash flow margin is 3.43%, all the way down. Okay, for the sector. The sector median PE non-gap ratio, forward ratio, 16.84. Okay, so I shaded those differently because they're different. Those are the median uh, scores for comparison. So I want to see everything else green. So if something is red, it's eliminated. And I have eliminated, for instance, Dollar General because they have a negative levered free cash flow margin. All right, as does Estee Lauder, as does Target, barely, but it's negative. So they're out. Tyson Foods, they're negative. They're out. Brown and Foreman, they're out. They're negative. I probably should have shaded the first part of that green. I didn't. But anyway, doesn't matter. They're out. And then Lamb and Weston, they're up, but they have a negative levered free cash flow margin. So they're out. Which other ones did I eliminate? Well, I eliminated Kraft Heinz. Why? Because they are red in the 5-year dividend growth rate. If you have a negative dividend CAGR, that means that at some point you cut your dividend. All right. So I'm not gonna bother. I'm gonna basically say no. So they had a negative 5-year CAGR for their dividend, as does Keurig Dr. Pepper. So they're out. As does Molson Coors Beverage. They're out. All right. So those are the reds. So we eliminated 1, 2, 3, 4, 5, 6, 7, 8, 9 of the 38 right there. Now, I also basically looked at ones that had yellows and I kind of said, I'm not eliminating them, but I'm probably not going to select them. So, for instance, if the dividend yield is less than 3%, I'm probably not going to select it. If the dividend growth rate for 5 years is less than 5%, it's probably going to be yellow, or I'm not going to select it. If you don't pay a dividend, like for instance, Dollar Tree, probably not going to select you. Here, doesn't mean I don't select growth stocks that don't pay dividends. But in this sector, I'm looking for a dividend. And let's see. So that's the dividend yield. If you have a dividend streak of less than 5 years, I'm probably not going to select you. I'm going to shade yellow. Um, if you have a payout ratio that is really high. For instance, uh, Clorox has a payout ratio of 93%. I think that is pretty high. So, even though they have a 45-year dividend growth streak, I think 93% is extremely high, and that gives me concern that the dividend may not be safe. If you have a levered free cash flow margin less than the sector median, um, so it may be positive, but if it's less than the 3.43%, you're probably going to be yellow. I'm probably not going to select you. So that's kind of how that goes. So then basically what I'm looking for, oh, wait, before I do that, let's talk about valuation, the PE ratio. So the PE ratio for the sector is 16.84. If you have a PE ratio, and I'm looking at the forward PE ratio, non-GAAP, if it's greater than 16.84, and if it's a little bit bigger, okay, I can live with that. But if it's significantly bigger, I'm going to say yellow, and I'm probably not going to select you. So, for instance, Estee Lauder has one of 39.95. That's, I think, too high. That coupled with that negative levered free cash flow margin, they're out. Who else is out? I will tell you that Tyson Foods has a PE ratio of 40. That's too high. Uh, Kenvue, theirs is lower, and that's fine. I did shade them yellow because I think they're new. I have shares of Kenvue, but I just don't think there's enough data there. So anyway, I'm passing on that one for now for this exercise. What else? Hormel Foods, I think, is a good company, but the PE ratio is a little bit higher, quite a bit higher than the sector median. It's 22 and a half versus 16.84. I think it's too high. Probably, um, it might be overpriced at this point. Others, Keurig Dr. Pepper and Coca-Cola. That's why I didn't choose, because their PE ratio is a little bit too high. Hershey's is a little bit high. Um, what else? Colgate Palmolive, Clorox, Philip Morris International. Okay, let's go to the next yellow one. Procter and Gamble. And Procter and Gamble was green on everything else, but their price is a little bit high. And you know what? I've bought high. Um, I bought a stock where the PE ratio was higher than the sector median because I thought it was still a good buy. But here I'm looking at the very best buys. I'm buying the dip, and this is one of the metrics I'm using. PepsiCo, 19 and a half. That's a little bit higher than the sector median, as is Monster Beverage. Monster Beverage also does not pay a dividend. So, where does that leave us? Let's go to the top. And I bolded and italicized these. JM Smucker, they are green across. So I'll tell you, they've gone down 27.67% year to date. Their dividend yield is 3.69%. Their 5-year dividend CAGR is 5.25%. So that is a healthy dividend growth rate. They have a streak of 22 years. They have a safe payout ratio of 43.55%. Their levered free cash flow margin is 13%. It's more than 10% than the sector median. The PE ratio is 11.85. It is cheaper than the sector median. Let's go to the next bolded italicized one that is green all the way across. Archer Daniels Midland. They are down 18.73% year to date. Their dividend yield is 2.47%. Dividend growth rate for 5 years, 5.78%. That is a healthy CAGR. They have a streak of 29 years. Their payout ratio is extremely safe. It's 21.88%. They can handle that. And their levered free cash flow margin is 5.5%. It is more than the 3.43% sector median. Their PE ratio is 10.1, cheaper than the 16.84 for the sector. And then, last but not least, Altria Group. Aha. Well, they are down 7.58% per year. Okay, so they're not down as much as the others, but they are down. And this is a cheap stock. It's trading for around $42 a share right now. Their yield is 9.32%. Their 5-year dividend CAGR, 5.85%. If you remember our rule of thumb, we like to see the yield and the CAGR together adding up to more than 10%. Well, this is almost 16%. They have a growth streak of 53 years. This is a dividend king. So sometimes people ask, well, that's a high dividend yield. Is it a yield trap? It is not. Okay, this is a dividend king. And you know what? They just raised their dividend in the last month. They did it again. Payout ratio, almost 76%. It's a little bit on the high side, but it's safe. Their cash flow is good because that levered free cash flow margin is almost 43%, more than 40% more than the sector median. And look at that forward PE ratio, 8.43%. It's half of the sector median. Folks, that's it. That's all I got. It's the Altria Group, it's Archer Daniels Midland, and JM Smuckers. Those are my recommendations. I have several shares of Altria. Archer Daniels Midland and JM Smuckers are on my buy list. I do hope you found this to be informative and educational. And if you'd be so kind, give this video a like and subscribe to our channel here at Dividend Blasters. And feel free to share the video with a friend. Until our next video, have a wonderful day and God bless.